Welcome back this week, everyone. We're going to talk about something that's going to absolutely happen, that's going to impact your life in March. The question is, are you ready and will you be ready? Let's talk about interest rate hikes. Let's go. So the central banking system of the United States is really controlled by something you know as the Fed. And why that's important is the Fed has already forecasted and projected in their minutes and in conversations since their last meeting that interest rate hikes are coming. And by are coming, I mean in March of 2022. So they're coming very, very fast. Now people are freaking out, and the market, as you may have seen, has had the worst January ever, especially the S&P. So now more than ever, you need to expect and anticipate what's going to happen next, because a lot of what the market is doing is baking in that interest rate hike into the economy right now. So what's also happening on the sidelines of this crazy tumultuous time in the stock market? You got cryptocurrency headed towards what looks like another crypto winter. People are starting to prepare themselves as much as they can for what that next economic cycle will look like for them. And you have inflation rising, you've got jobs that are concerning, and people are starting to say, okay, how do I pull back and prepare? You stop spending as much. You start being a little bit more conservative of the things that you're doing, and you prepare for what might be investment opportunities or for things to just get more expensive in general, which is the underlying sentiment of what happens in an inflationary economy. Things that used to cost a certain amount of money now cost more. And for a lot of viewers who are going to watch this, you're going to say, well, Chris, that's kind of obvious. When things inflate, they get bigger. Well, yes, they do, but there are also side effects that can really impact the way everything else in the economy functions. 75% of gross domestic product is consumer spending. The GDP in this country can go up and down based on how much you or I spend on any given basis. And I'm not going to bore anyone with the technical nuance of how monetary policy works and how spending can change and interest rates go up and down. But what I will say is there's some things to think about strategically as it relates to your future and how your money will play out during this time. Number one, sooner or later, deposit rates are going to go up. It may not be commensurate with the interest rate increase. It might not be a 25 basis point increase like we're going to see in March from the Fed go up in your deposit rates, but over time, deposit rates will go up as interest rates rise. So money that you normally couldn't put into like a money market account or a CD and expect a better yield, you'll actually get some more money there. But the downside is loans will cost more. Loan interest rates will go up. This market, if nothing else, has been exceedingly hot for real estate. Across the United States, homes went up on average about 20% in value in a single year. At the same time, inflation went up that 7% that I already talked to you about, which means consumers who are earning money, their salaries, if they didn't get a salary increase of 7%, are now going to make less than they were making the year before. And at the same time, if they want to buy a house, it's at really, really high values, 20% higher than if they would have just bought just last year. The market is saying, you know what, interest rates are going to go up and, things are going to happen. But according to Moody's, S&P, CoreLogic, they're saying that home values are going to continue to go up. And they're saying, approximately 3 to 5% this year in 2022. I would point out that was the same prediction during 2021. And what happened? You got a 20% increase. Well, nobody really knows. It's an unprecedented economy, but what I will tell you is these large non-bank lenders that are out there are almost always refinance heavy. The core of their business is always people who are trying to refinance to lower their rate or to pull out cash, or if they're on an adjustable loan, get on another adjustable loan. That business slows dramatically as interest rates rise. Now, will it stop businesses enough for there to be layoffs in the industry? I don't know. I would say a quarter point increase from where we are right now, which is at historic interest rate lows, is not going to be significant enough to move the needle to really stop the refinance business. But the Fed has said to expect more than one increase this year. Some people were saying there was going to be a 50 basis point increase in March. I think now the general sentiment is that there'll be a 25 basis point increase in March, but I think you can pretty much guarantee there will be another increase in the year, depending on how the economy responds to this initial March increase. So the question is, by a lot, Chris, why are we increasing rates? Well, without getting technical, like a rubber band, the more you pull on an economy and let go, that elasticity gives you swings in the economy. When you think about an economy in the context of tens or even hundreds of years, it's very cyclical. Sine wave up, sine wave down. It's a pattern over time. There's prosperous times and not so prosperous times, known as recessions. Typically 7 to 10 years between economic prosperous economy and economically recessionary economy. Well, this has been a 14-year period, and some have argued, and I am one of those people who say that when you remove the elasticity from the economy and you let things deflate for as long as you can by pandemics, artificial interest rate deflation, and a number of things that have been built to keep people, well, frankly, secure, you've removed that elasticity from the economy. To put it back in, you need to push the rubber band pretty far out, and a quarter basis point increase isn't going to do that. But in order to have a healthy economy, you can't just have real estate values go up over time. If homes get so expensive they're out of reach for the majority of America, people stop buying. And if people stop buying, they feel discouraged. There's emotional drawbacks, GDP will go down, and things will begin to cost more, like this inflationary economy that we're seeing. Bread will cost more. You'll start having supply chain issues. People, can't get products. If you want to buy a new car prices right now have gone through the roof. You want to buy a Mercedes-Benz, some of them have $20,000 or $30,000 or more dollar markups on them. So all these things are making typical average everyday consumer purchases much more expensive to get, and you need a little bit of that back and forth. Now, real estate wholesalers might feel the pressure of that. People who are in the real estate business, realtors, for example, or brokers, people who are in the lending business, they may all feel the pressure of that interest rate increase, but bringing values down as supply in real estate continues to grow to come back to this homeostasis level or close to as normal as you can get is really vital to long-term real stability. If you're trying to buy a house and markets only go up and up and up and up, and you're already priced out, there's no ability for you to catch up to this rising market. Healthy economies have this ebb and flow. Like many things in life, it can't always be winning. You have to have a little bit of dips, this little bit of adversity to overcome in order to appreciate the really, really prosperous times. So while there might be a connotation to this in the markets with wild swings in the stock market and wild changes in pricing and things like cars may cost more money and home prices have gone up, I would argue that the pain of what's coming next, not a recession, but a slowdown as interest rates start to rise and fiscal policy changes, I think is a very, very good thing. And while we're seeing a little bit of corrections in the economy, I think there's more corrections to come. And for those of you who follow me and you're really into cryptocurrency and NFTs, I think that market is also suffering because people are afraid to spend money when they don't know what's going to happen in the market, but also because it's getting to the point now where the SEC, somebody has to step in to help regulate cryptocurrency's impact in undermining fiat. The blockchain has tremendous value. I'm still a fan of cryptocurrency. I'm still a fan of NFTs, but understand that all of these things are going to change in the landscape as money and policy becomes tighter. I wanted to walk you through a very generic, basic impression to come to this one conclusive thought. Don't freak out and don't let these things intimidate you. Millionaires are made in down markets. It's very difficult to become a millionaire in a super positive market. If you're into real estate, keep buying real estate because you know what? If those values go the other way and they go back up, you're a millionaire. Keep doing what you're doing. If you can survive a recessionary economy, you can survive these challenges, you're going to be better on the next side of things when the economy changes. But be malleable, be adjustable, and be prepared to continue to invest in what you're investing in now with costs rising. Because just like there's no way to beat inflation, the only way to beat inflation is to keep doing what you're doing over time because there is no one strategy that will outperform the market. And this is no different. If you're investing in the stock market, if you're investing in real estate, keep doing those things strategically, do it over time, bear with the pain, and when you get to the other side, you may be a millionaire. Thanks for tuning in. Appreciate you following us. We'll catch you next week.